Today, I am going to show you how to invest your first $100, or $10, or you could even start with $5. There are many types of investing, to be honest. You could invest in stocks, shares, equity, government bonds, corporate bonds, real estate, crypto, NFTs, art, watches. There seems to be so much stuff to invest in. Add the very real risk of losing money, and investing seems too overwhelming and scary for people. And that's why I am here. So, let's start with the philosophy and basics of investing. What is the point of investing? The point of investing is for your money to make more money. Let's say you have $1,000 that you have earned through working hard at your job. Now, you could put that money in a bank current account. But the problem with that is, there is this little thing called inflation. You might have heard about it. It basically means your money loses its value over time. Something you can buy for $100 now will cost $120 in the future. The dollar currency from the start has lost almost 95% of its value, which is why it's important to invest in something, because when you invest in something, your money makes more money. So the philosophy behind it is that you buy something now, and that thing makes you more money later in the future. So there are two ways the thing you have bought can make you more money. Let's say you buy a house. The two ways that house makes you money are, number one, you can rent it to somebody and generate rental income. And number two, the value of the house mostly goes up over time. If you hadn't had the house and had that money sitting in a bank account, over time your money would have been losing its value. Also, houses are an interesting example because you have rent, and everyone can imagine what and how rent would come in. But most of the time, it's just you buying something, hoping it would go up in value, and selling it at a higher price. Now, there are some exceptions to this, about which we will talk in the later part of this video. The asset classes are something you might have heard about but don't really know about. So, in them, we have stocks, shares, and equities, which are kind of the same thing. You have hedge funds, index funds, bonds, government bonds, corporate bonds, and a whole lot more. But we are only going to talk about the stocks and shares part because that's the only thing people like you and me can viably invest in. It's relatively low risk and doesn't require huge capital to start with. Alright, so when you are investing in a company, you are basically buying a share of the company. Let's say you want to buy shares of Apple because Apple is a publicly traded company, which means the public can trade Apple stocks. After buying Apple shares from a broker, which is basically a middleman, now I own a piece of Apple. With this, I can make money in two ways. Firstly, I am hoping that the share I have bought will increase in value over time. And the second way you can make money is similar to rental from your house and is called dividends. But only certain companies pay dividends, which is essentially the company paying some of their profits to their investors. Okay, so now we are accustomed to all this owing a part of the company and stuff, but how are you supposed to know which company's shares to invest in? Should you put all your money in Apple, Google, Meta, or Disney? Or should you go with Shell or British Petroleum, or any brands you might be familiar with? And for this, I am going to tell you about billionaire Warren Buffett's opinion, which is also my opinion. That is, unless you are a financial professional who literally does this for a living, you should not try and pick stocks. There are literally people who do this as a job and still don't get this right all the time. And hence, instead of this, what you can probably do is invest in an index fund. So what is an index fund? Well, it is basically a group of stocks and shares which tracks a market index. For example, the most famous index in America is the S&P 500 Index Fund, which basically includes the top 500 companies in the US, and it is divided in ratio to their size. For example, look at this. Apple makes up 6.86% of the S&P 500. Microsoft makes up 5.78%, and so on and so on. And you might be familiar with a lot of these companies, but they also contain different other companies, the more obscure ones, which are also in the top 500, but you might never have heard of, like Hasbro Inc. or Assurant Inc. This index fund kind of gives you an idea of how valuable the US stock market is, because most of the value of the US stock market is in these companies, and they generally only go up unless a recession hits. Your money's value keeps increasing. So, for example, you invest $1,000 in the S&P 500. That means your $1,000 is now split into these 500 companies by the size of their weighting. And generally, the bigger the company, the less likely it will fail. So it's a good investment. Now, out of my $1,000, $64 would be in Apple, $54 in Microsoft, and so on respectively. This is brilliant, and this is what Warren Buffett recommends. Because of this, your money over time tracks the market because you have diversified your money, which means you are hoping for the biggest companies to grow over time, which they will because all these companies are creating something where people are working, providing value, which in turn is increasing the value of the company. Now, what's the alternative? Well, instead of an index fund, you can choose individual stocks, but most of the time you are not going to beat the market. And even if you get very lucky, you will not be able to do it consistently. Also, this is not financial advice, but Warren Buffett even did a challenge around this where he just invested in the S&P 500, and on the other side were the top financial advisors carefully picking the stocks, and the S&P 500, over time, comfortably beat the investors. Very few funds overall actually outperform the S&P 500. So as Warren Buffett and all these smart people say, don't think too much and try to beat the market. Just invest in the market through the S&P 500. So, how to invest in it? Basically, you can do that through a platform. And if you want to find a stocks and shares investing platform in your country, you can just Google that. For example, something like Vanguard or Fidelity. Also, I am aware there might be some common fears, concerns, or questions about investing. You can only lose money if the value of your investment goes down. And people do think, if I invest my hard-earned money in this, what if it comes crashing down to zero? And it can happen. But let's say you bought $1,000 worth of S&P 500 shares just before the 2008 market crash, and the market crashed by something like 60%. Here, if you sell your shares, you have realized your loss and actually lost money. But if you had just held on to your guts as the market recovered, coming back to the same level by 2012 and then kept going up and up, by now you would have doubled or tripled your money. The market broadly goes up with time, just like houses. The value always goes up over time. Also, the longer you keep your money invested, the bigger it gets, courtesy of compound interest. One of the common questions is how much you need to start investing. Well, you can start by literally $5 on a lot of platforms. There are risks in investing, but there are much bigger benefits as well. If only the rules and ways of investing were taught in school, it would have made people's lives so much easier, and they wouldn't be afraid to invest in it. Investing in property is also a very good option, except you would already need to have a decent amount of capital to get started.